You likely have one right now, a piece of plastic with $25 or $50 on it, shoved into a drawer and entirely forgotten. Every year, consumers load tens of billions of dollars onto these cards. It's a massive pool of capital, much of which will never be spent. A gift card is a debt the retailer owes you, a multi-billion-dollar entry on a corporate balance sheet. Retailers push these year-round because they generate profit in three distinct ways. They act as interest-free loans, they trigger overspending at the register, and they eventually become unearned revenue. In a normal retail purchase, you hand over cash and immediately walk away with a product. The company exchanges its inventory for your liquidity. Compare this to a gift card purchase. The company takes your cash, but the product remains on the shelf. By holding your money, they improve cash flow, investing and earning interest for months before you claim an item. When you finally do redeem the card, a psychological shift occurs. Because you didn't earn that specific $50 that day, it feels like free money. This bar chart shows the result of that mindset. A shopper with a $50 card often buys an $85 item, spending an extra $35 of their own cash to complete the sale. Retailers rely on this predictable behavior to trigger a secondary wave of revenue that significantly exceeds the original value of the card. Mathematically, a gift card provides the retailer with more upfront liquidity and a larger final sale than a standard cash transaction. The most profitable scenario for a company, however, occurs when the card is lost or forgotten and the money is never spent at all. Of total gift card funds, the portion never redeemed is called breakage. With no product handed over, there are no manufacturing costs. That balance moves directly onto financial statements as pure 100% margin profit. Laws regarding expiration dates and fees vary globally, but eventually, corporations are legally permitted to absorb these dormant funds into their bottom line. But there is a risk to this system. The same traits that make gift cards efficient for business, their liquidity and lack of a linked bank account, make them untraceable assets. Fraudsters exploit this by draining activated cards or tricking victims into using gift cards as an anonymous payment method for fake debts or ransoms. Because these transactions are detached from your identity, there's no central authority to call and no way to reverse payments once the numbers are shared. The features that generate risk-free corporate profit also make gift cards the preferred, unprotected vehicle for international fraud. The physical card in your wallet is a time-sensitive asset with a diminishing return for you. This chart shows the diverging paths of that card's value. For you, the purchasing power drops over time as inflation makes the card less valuable. It is a depreciating asset. For the retailer, the time value of money makes that same card an appreciating asset. The longer they hold your cash, the more interest they earn, which widens the gap between your loss and their gain. Every day a card sits in a drawer, the likelihood of it being lost to corporate breakage or drained by a scammer increases. Treat your gift cards like expiring cash. Spend them immediately to capture their full value, and never use them to satisfy an urgent demand for payment.